Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.
Today, we're really going to be getting into right where it says on the screen, the market dynamics. What in the heck is happening in the world of mortgage banking and real estate? And, what are we kind of seeing on the horizon? And how do we navigate kind of, almost every day being a little bit more of uncertainty? Where is the market going to go? How are we going to react? What are mortgage rates going to be like? And then how is that overall going to affect, you as a realtor, really finding great opportunities for your borrowers to either list a house or buy a house. And one of the great things that we do here at Guaranteed Rate Affinity is these kind of calls. We really share a lot of our knowledge with our loan officers to make sure that they can help kind of explain what we see on a day in, day out basis to you in your local markets, and to make sure that you're getting, very clear and concise, up-to-date information. So my hope is that if you're not working with a Guaranteed Rate Affinity loan officer, that you kind of look at what we're doing with these kind of calls and, realizing that we are really keeping our loan officers informed and up to date, because the more informed that they are, the more transparent they can be along with you and your borrowers, and to make that whole process hopefully as easy as possible. So with me today is one of the top capital market leaders in literally the entire country, of all mortgage banks and banks in the country, with Jeremy Collett, who is our Chief of Capital Markets for Rate Companies. So Guaranteed Rate Affinity is a sister company to our larger company, Rate, and Jeremy kind of oversees that entire umbrella of Rate Companies. So Jeremy, pleasure to have you on today, and this is a great day to kind of talk about what in the heck is happening in the mortgage banking world, and how, as someone in your shoes that really kind of sees a lot of things that the rest of us don't see, how you can help us kind of understand in a little bit more of a chill fashion, hopefully, what's going on out there.
Yeah, well, good morning, everyone. Thanks for having me here. And yeah, and my job, and just to kind of shed a little light on what we do, I think everybody understands kind of the core secondary marketing roles that we play, from product pricing and all of that. But we also manage all of our product offerings in terms of mortgage products. So the non-QM stuff, our rate portfolio products, jumbo, ARM products, home equity products, et cetera. We have about a $36 billion portfolio of MSRs that we manage and actively hedge, as well as just work with our CFO and Victor, the CEO of basically all the companies under the Rate umbrella, with strategy, planning, financing operations, et cetera. So all the things that you see on the headlines have a pretty meaningful impact on everything we're doing on a day-to-day basis. And we were talking before the call, there's about 50 or 60 people in trading and product and portfolio management on the capital markets team. So I think what's really interesting now, and just to kind of frame up the discussion, is we're no longer debating higher for longer or whether or not it's real. We're literally living in it every day, right? So And what I mean by that is markets are being driven less and less by Fed speculation or by politics, et cetera. And the Fed has, I guess, stepped away from their expansive mandate under, or after the great financial crisis of stabilizing the economy and using monetary policy for sort of non-dual mandate purposes, meaning managing inflation and employment, because you see where that landed during pandemic. Obviously, it's pretty well accepted now that the Fed left too much accommodation in the markets via zero interest rates and quantitative easing, which led to inflation rates that we hadn't seen since the Jimmy Carter era. And even today, nearly 5 years later, all of that inflation noise is still persistent, and inflation remains pretty well above the Fed's 2% mandate. So where we're at today is rates, or the neutral, interest rate is generally higher than it's been throughout most of our careers right now. Investors demand a real yield, not a 1% to 2% kind of treasury rate, but a real return on their money. And you see that everywhere from bond yields to mortgage pricing to even bank deposit rates, right? Which forever banks didn't pay you anything for your money to sit in a checking or savings account. And now I think even today you can buy 4 and 4.5% 1 year or 2 year CDs, right? So you've seen the whole pendulum shift on interest rates from using rates as basically a mechanism to drive economic growth to now investors and even consumers require real yield after what happened with prices across the entire consumer and producer spectrum due to COVID. So this chart shows where 30-year rates have been. And fortunately, we're not talking about 7.5% to 8% mortgage rates, even though we were there at one point, in 2022, 2023, when rates were at their highest. But for the most part, rates have been sort of range bound between 6 and 6.5. And a lot of that now has to do with geopolitical tension, as well as something we're calling oil shock, which I'll get into in just a second. But as long as inflation stays persistent or near or above 3% and nowhere near the Fed's target, which is 2%, this is kind of the regime we're in right now. Rates higher for longer. That's our base case, but there have been some opportunities that have brought in some, what I would call mini refi waves. Generally speaking, that's when the 10-year approaches around 4%, and we've seen 3 or 4 times now where the 10 years dipped under 4%, and a lot of times it might have been just for one day. And then mortgage rates also flirt when that happens with around 6%. So we have seen some fixed rate mortgage rates under 6% over the past few years. But again, like, rates have mostly traded sideways, meaning they've been in this range over the past year or so. We can move.
Hey, Jeremy, would you mind just for maybe some of the folks that are on the call, the 10-year note, obviously something that we all know in the mortgage banking world is something that we can kind of get a gauge as to where rates, may go up or down just watching that 10-year. Would you mind maybe explaining it to those that may not know,
Sure, yeah.
Why is the 10-year kind of an important gauge to follow?
Yeah. So I liken it to like the stock market, right? If you're just generally talking about what are stocks doing, you might go look at the S&P 500 or the Dow Jones Industrial Average, right? And like, I do that all the time. It's all up on my screens right now. But that just gives you a barometer of like what stocks are generally doing. And the 10-year Treasury note is that sort of benchmark instrument for the bond market. Nobody quotes the German 10-year or bonds from other sovereigns as the benchmark. The US, the dollar is the benchmark for the world economy. And generally speaking, like the 10-year is just that kind of headline benchmark number to talk about rates. Now, there's a lot of difference between the US 10-year note and mortgage rates, a lot of difference. If you buy a 10-year bond or any treasury bond, they're going to pay you throughout the duration of the term of that loan. So if you go buy 10-year notes yourself right now, you're going to receive cash payments for 10 years. Mortgages aren't like that. If rates fall, folks are going to refinance. The average 30-year loan has a life of about 4 to 7 years as people upsize or downsize or move or refi or whatever, right? So from an investor standpoint, mortgages carry a lot of behavioral risks that need to be modeled out, and that's specifically prepayment speeds. There was a time when the credit spectrum was a little wider where default risk played a part in that too, right? So not only would you stop receiving your payments as an investor, but then you'd have to manage through delinquency and maybe even foreclosure and things like that, right? So I think a lot of times people ask me, how are mortgages priced off of treasuries? And I would say they're not. We just use that as a talking point to generally talk about interest rate direction, but mortgages for the most part are securitized into mortgage, equivalent bonds, and then we sell those bonds to investors, and that can be in the form of Fannie and Freddie MBS, which is probably what most people are used to seeing and talking about. But FHA and VA loans get securitized into Ginnie Mae MBS, and we create both of those types of securities and sell them with our production. And then there's another, and if you watch The Big Short, this isn't news to you, but there's loans that don't qualify for either of those products that get securitized into non-agency mortgage-backed securities. That market obviously took a beating after the financial crisis, and it took about 10 years to start to see activity again, but now that's where like all of the home equity products, jumbo loans, and non-QM loans ultimately sort of end up as securitized products there. And we manage a securitization shelf as well. Not many lenders have that capability, but we manage something called the Rate Mortgage Trust, and it's where we take our jumbo production and we securitize it and sell bonds directly to investors. So there's not a middleman in our jumbo activities in the secondary market. Like, we actually make the sausage ourselves, and that's a really fun space to be in if you're in my seat. Because we deal with all the institutional investors that buy bonds from PIMCO to Bank of China to whatever. So it's a little bit different than everything else we do, but it's definitely exciting to be like on the frontier, if you will, of structured finance here at Rate. So we take a lot of pride in our ability to do that.
Well, you guys do a great job. So let me move over to the macro backdrop here.
Yeah. So again, like, ever since this paradigm has shifted to this, let's call it new level of neutral rates, inflation has been the main headline, right? We did see CPI rates in 8, 10, and who knows, maybe they were 15 and 16. Like, there's some debate about like where inflation really got to back in 2020 and 2021. But we generally think of core PCE as the inflation indicator that matters. That's the one that the Fed looks like. And right now, though we've, you can see like core PCE inflation has dropped from the high 5s down to about 3. But even at 3 or 296 to be precise, that's still roughly 100 basis points over the Fed's objective of 2%, right? So if you think about the Fed's motivation to cut rates, cutting rates is not going to help bring inflation closer to 2. It's going to do the opposite, right? Like, lower interest rates means there'd be a higher demand for money, and people would be borrowing more to spend more effectively, which would grow the economy and grow prices. So cutting rates actually has the opposite effect of on inflation, that's needed for the Fed to cut rates. So that's sort of the problem right now.
Can I ask you about maybe one caveat with that, Jeremy, is the amount of money that people are making above inflation. So if wages are going up higher or faster than inflation is going up, even with a rate cut, would that offset, that rate cut? So, borrowers are making more money, accelerating faster than inflation. The Fed cuts rates, and I know that the new nominee to be the Fed chair is probably in that seat because he is going to be more, geared towards being a little bit more aggressive on rate cuts. Do you see that that the wage part of it is going to play a bigger role in whether we cut or don't cut?
Yeah, I mean, that's a great question. And that definitely factors into core PCE, right? Because, consumer demand and supply, obviously, that has an important role in prices. So they're all interlinked, I guess, which, we all learned that in the first economics class that we ever took. But even right now, like the wage push inflation is even higher than core PCE inflation. So wage inflation year over year, according to average hourly earnings on the last month's employment report, was at 3.5%. So you've got even a bigger inflation problem when you're talking about things like average hourly earnings than just core PCE. So I think, again, that provide headwinds to the Fed, even when Warsh begins next month as the new Fed chief. That's still a major headwind, and we'll talk a little bit in a minute. I think the next slide's interesting because this is definitely, I guess, a conflict between the Fed's two main interests, right, or areas of focus that oppose each other right now. While wages are higher, inflation has remained around that 3% level, which is above the Fed's mandate of 2%. Non-farm payroll gains continue to just sort of fall down to this, 50,000 a month growth number, which is pretty poor, by comparison to the, numbers that we saw immediately after COVID and, 2020. We had an average non-farm payrolls growth number of around 600,000 back then per month. And you can just see over the last 5 years, that's been trending towards zero, right? So this is cause for concern. And you keep hearing about folks and economists who are concerned about, the job market and job growth. And the 5-year chart of non-farm payrolls really shows that pretty nicely. You can see where we've fallen off a cliff, since 2021. So these are, fortunately, let me see where unemployment is. I think it was 4.3. So the unemployment rate at 4.3 is still fine. No cause for concern there. And then when you just look at other things across the economy, consumer spending's been on fire. ISM services has been on fire. There's really a mixed bag of data that the Fed's watching right now, right? And I would say non-farm payroll growth, while it's extremely important, it's one of the only indicators that's kind of sticking out that's underperforming where the Fed would like. But it's expectations around what's going to happen now that we've introduced all of this geopolitical tension into the markets and oil, trading at $100 a barrel, causing gasoline prices to spike up to about $5 per gallon nationally. What's that going to do to growth? And right now, economists are pricing in about 2.5% GDP for this first half of 2026, and then recovering near 3%. So you are seeing this growth concern sort of get priced into the bond market. But again, like the dual mandate of the Fed is to manage inflation at 2% and ensure that the employment market is operating at full capacity. So you got cracks on one side of that, but the other side, inflation is still running super hot. And obviously, $5 a gallon gasoline is inflationary, right? So we expect to see a short-term uptick in inflation, which isn't good for the prospects of cutting rates. We can go on to the next one, and I think I just kind of covered this. So here's that GDP forecast I was talking about, slipping from nearly 3% in 2023 all the way down to around 2 and even lower in the forecast going forward. So you see a little bit of an uptick there as we get later into the year, but then I think as things have progressed in the Middle East, and now we're on the eve of the ceasefire deadline, which is tomorrow, and I see Trump's firing tweets off, and the leadership in Iran is not participating in the peace talks that are supposed to be happening in Turkey or Pakistan. I think they've had them in both. It looks like this conflict's going to weigh on the markets a little longer, and unfortunately, that's why the bond market's trading off a little bit today.
One of the things with the oil prices, it's obviously, there's nothing that hits, things getting more expensive. If oil gets more expensive, it literally is kind of the lifeblood of everything that we touched. And especially anything that goes into building or buying a new house, it has to be transported there on something that it probably requires some kind of fuel. So, I'm always curious, do you look at, in the capital markets world, is there like a 3 month, like if this goes past 3 months, then holy smokes, then it's a new game? Or, how do you guys calculate that risk with the duration of how long these oil prices can be elevated for, and still be at affordable mortgage rates and just rates in general?
Yeah, no, that's a great question, and it's really difficult to do that because, as you can probably imagine, people's predictions or views on how this geopolitical tension ends are all over the place. And in my seat, we're a pretty big customer of Wall Street, like most of the banks there. So I have access to some really smart people who run like rates trading desks and futures desks at some of the big banks. And I remember one of the heads of interest rate trading told me, hey, I've got a really good buddy in the Defense Department, or the Department of War, as it's called now. And his view was that, and this was back, this was at Sawgrass at the Players. So when was that? That was like mid-March maybe. But his view is that the U.S. would basically be out of military targets in a week, and that this thing would be over. And as soon as it was over, bonds are going to rip higher and rates are going to fall. Well, at this point, that was 2 months or over a month ago, right? So again, that was a very credentialed person with a view and thought he had intel. That didn't really happen. So you hear all kinds of stuff. It's hard to take a position. My view now, it's kind of consistent with this presentation, like the paradigm shift for where interest rates should be on kind of a base case scenario is much higher than it's been throughout most of my career, right? And that trajectory of rates just falling year over year on average until they got to zero kind of ran its course, which is, what's funny about that? Like I used to keep just a chart of a long-term view of interest rates over the past 30 years, basically since the Carter era when inflation was a problem last. And it just kept focusing and trending down to zero. And I was like, you know what, one day we're going to get to zero. and the whole world's going to change. And that's kind of how I feel about what exactly happened. You know, with pandemic, the markets were shocked. The Fed got involved, started buying, you know, trillions of dollars of treasuries and mortgages, cut interest rates to zero. We had real negative interest rates for investors across the country. And then inflation exploded and kind of pushed us to where we are now, right? So I think most people look at the current market through the lens of where they've been in their careers over the last 20 years or so. At least in my case, it's 20 years. And it's hard for folks to imagine that rates aren't going to be at 3 or 4, but I think that's exactly where we are. So I've stopped fighting the, you know, sort of all the folks who were really bullish about interest rates falling and the Fed cutting. Because inflation's like a real problem that the Fed has to deal with, and they know they basically messed up. Like they kept too much accommodation for too long. The inflation problems we were seeing weren't transitory, they were real. And the market was just flooded with cheap money for far too long, and like these are the consequences. So I'm generally not that bullish on bonds, although there are a lot of people across the company who are, but like I just appreciate what's happened for what it is. And in the grand scheme of things, like 6% interest rates aren't so bad. So the markets are still functioning, people are still refining and buying homes, and business is still getting done. And you can see that in the numbers. So I've kind of quit trying to fight that and put a trade on, you know, as you know, the Fed's really got to get in and start cutting rates because they really don't have to do that. And you can see that as a nice segue into this, right? Like you can see the Fed's forecast. A lot of people ask, because we put out, like I write commentary for our employees every day. And then we put out a podcast. We do other things, you know, throughout the week. We put a newsletter out. But one of the components of it is always what's a Fed forecast, right? Because everybody wants to know what the Fed's doing, as they should, because it's driving, you know, the 10-year is a benchmark bond instrument, but it also is looking at the Fed, right, to see, because, you know, where they're going to move interest rates. Because at the end of the day, all the people that buy mortgages and buy treasury notes, they use Fed funding to do that. So it's kind of like a levered trade. Like I'm going to borrow Fed funds to invest in mortgage-backed securities or treasury notes. So everything kind of does follow the Fed. Even the stock market does now, believe it or not. But we put this out pretty regularly, our forecast on what the Fed's going to do when the next cut will be. And right now we've got 1 or 2 rate cuts priced in. I think at one point there were like 4 or 5 rate cuts priced in that have been pushed back, and that's like the 4th or 5th time over the last few years that that's happened. But where do these come from, right? Basically, there's an interest rate futures market where folks use it to hedge their interest rate risk for the most part, but obviously hedge funds are in there, you know, speculating on when the Fed will cut and this and that, or hike, you know, God forbid. But that's where this forward curve of Fed rate cut expectations comes from. It's mostly from the futures markets. And, you know, it's published on Bloomberg, and there's like a real-time index that's updated. Today's kind of interesting because Kevin Warsh, the new you know, Trump's appointment for the new Fed chief, is on Capitol Hill. They're basically going back and forth with the congressmen on the Senate Banking Committee about maintaining Fed independence. Seems to be the topic du jour. You know, everybody's afraid that the Fed will lose their independence somehow or whatever. But, you know, to me, it's interesting. They're the only, you know, major government entity that's not really part of the government, that has no check and balance. You know what I mean? So we could debate about that all day long, but we'll stay away from that one for now. But that's kind of what's going on. So there's really nothing about interest rate policy to take away from what's happening in Washington, D.C. right now. But yeah, we initially thought Warsh would be a lot more dovish, meaning he would be more aggressive to cut rates and stimulate the economy. It doesn't seem like that's going to be the case. Like the markets aren't pricing that in anymore. And I think I even said in the past, that would probably be the time next month when the Fed got aggressive about cutting rates. Who knows? Maybe it will be, but again, we're pricing in 1 to 2 cuts this year, if any at all. And that's what the market thinks. So,
Jeremy, what do you like those cuts? Do you think will be like a quarter? Do you think maybe by the end of the year will be a half below where we are currently?
No, I mean, something big would have to happen for that. Some kind of event risk, which unfortunately we're developing like disaster recovery plans to operate the business in case there's another GFC or another COVID or whatever. But it would have to be something like that. So barring some major headline, no, I don't foresee 50 basis point cuts. And with oil prices, this is a really cool chart that our team put together, but it just shows you the price of oil and its relationship to the treasury rates. So as oil's gotten up to 100, that's when you see treasury rates getting up, on the 10-year anyway, up to 4.5. Mortgage rates would be up to 6.5, or 6.5-ish there. And then when oil, since the onset of this conflict with Iran, when oil's gotten down to 80-ish, rates have fallen 50 basis points. So this is just a little correlation analysis between oil and rates, which seems to be the primary driver of everything right now.
That's an amazing chart. I've never seen the 10-year and the crude oil priced on the same chart like that before. That's amazing.
Yeah, I mean, it's just, again, this is what we call oil shock, meaning the impact that oil's having on inflation expectations, which that's the key driver of how the Fed's setting rate policy right now. So it makes sense if you think about it.
And so ultimately, I think probably a lot of the agents that are on the call right now are like, Jeremy, take out that crystal ball. We get it. It's a prediction. But where do you think we're going headed into the summer?
Yeah, look, the summer, I don't expect much to change. I think rates are going to, at least fixed rates will probably remain in this 6 to 6.5 range. The good news is the yield curve steeper, which means rates that are lower in tenure offer some value right now. And we've seen a major uptick in ARM production. So for government and conforming arms, you can get rates in the 5s, maybe even 4s. Jumbo arms have been a huge success for us. We're finding good buyers of jumbo arm production, again, with rates in the low 5s right now, maybe even high 4s in some cases. So our ARM production last year increased from about $1 billion the year before to I think $8 billion last year. It was just massive. So that's good news. Like, there are borrowers taking advantage of yield curve dynamics and getting some cheaper financing by going into an ARM right now, including Jeremy, Collett, myself. Yeah, I think throughout the summer, rates are kind of range bound, continue to see strong ARM demand. As the year progresses and we get closer to one of those rate cuts, maybe we see rates fall a quarter to 50 basis points, along with the Fed. But again, that's still heavily dependent on inflation and what happens in the Middle East.
Yeah, it's a very interesting part of the timeline that we're all living in right now.
For sure, yeah.
It seems like every single day that there's something that we're waking up to that seems to catch us a little off guard. But so everyone, please connect with your GRA loan officer. Again, this is something Jeremy shares his commentary with our loan officers, literally not only daily but throughout the day, making sure that we all know exactly, again, how to articulate what is going on in the mortgage world with you. And making sure that we're also, again, making that experience for your borrowers as transparent and as easy and as knowledgeable as possible. So for everyone on the call, thank you very much for attending. We're going to have the next 2 months. We have some other great guest speakers that will be joining us as well. But Jeremy, Collett, I really appreciate you, the capital markets team at Rate Companies, for doing such a great job and keeping us very aggressive in the market. So everyone, enjoy the rest of your day, and thank you very much.
Yeah, thank you.
Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer, even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.